I think it's important to start with a rather eye-opening statistic. After inflation and taxes, cash, on average, has lost its value each year. This includes cash held in a GIC or some other vehicle that yields the risk-free interest rate. So by owning cash, you are betting on an asset class that will likely erode by 1% to 2%. But let me break that down a bit more and add in some really important details. If you're investing at the highest marginal tax bracket, like many of my clients are, either through a personal non-registered account or a corporate account, then you're paying about 53% in tax on any interest income. So if you buy a GIC that yields 4%, half of that 4% is gone in the form of taxes. Then you might say to me, okay, Emmanuel, fine, but I still earn 2% after taxes. And to that I say, don't forget about inflation. The only reason a GIC yields 4% is because inflation rose to 4% or higher at some point before that. So if inflation averages 4% for the period you own the GIC, then your real return on that GIC after taxes and inflation is negative 2%. That was a theoretical situation. Let's look at real numbers. I looked at US figures from 1970 to 2020, when inflation averaged 3.9%. Cash rates averaged about 4.6%. Sounds good up front, but if you cut this in half by 50% for taxes, and then by 3.9% for inflation, for 50 years, cash averaged a return of negative 1.6%. And even if you aren't in the highest marginal tax bracket, a person in the 35% tax bracket still averaged an annual return of 0.9%. So now that we've established that cash is a bad investment, it's important to note that it doesn't mean you shouldn't have any cash at all. There are still a few good reasons to hold cash. First, you might have short-term cash needs, such as retirement income, or perhaps you're on a commission-based income structure, so you like to have an emergency fund of 3 to 6 months of expenses, ready to draw on in case you go through a sales slump. Another good reason might be a major upcoming capital expenditure, such as a wedding, or perhaps you're saving for a down payment for a property. What's the common denominator between all these examples? A short-term time horizon. When you have a need for money that isn't covered by your recurring income sources, you can't invest the money because an investment portfolio might lose value in the short term, and then you have to pull the cash out before it is time to recover. When you have a short-term horizon and a clear need, stay in cash and find the highest yielding risk-free product that keeps it liquid and accessible. If you have cash that is neither for short-term needs or for an upcoming major expenditure, then we recommend you invest it in a diversified portfolio that stands a good chance of growing your money in excess of taxes and inflation. Otherwise, you're probably just holding cash because it feels good, and like many things in life, the easiest path often bears the least fruit.